Good afternoon, ladies and gentlemen. Welcome once again to our monthly Inclusiv Town Hall call, focusing on issues related to the COVID-19 crisis. This is our 19th installment. We're really getting up there. My name is Jules Epstein-Hebert, Director of Membership. We're going to wait a few minutes for participants to join the conversation, and we'll get started in just a few moments. Welcome once again, everybody, to the monthly Inclusiv Town Hall series for issues related to the COVID-19 crisis. We're really excited to have you all back for part 19, and we have some very exciting guests with us today who we'll introduce in just a few moments, but you may see their images on your screen. Today, first of all, my name is Jules Epstein-Hebert, Director of Membership at Inclusiv. Really happy to have you all with us today. We'll be discussing various issues related to the ECIP ECIP program, as well as some other topics of conversation. I just wanted to let everybody know that we will be sharing slides, resources, and the recording from today's presentation with all registrants and attendees later on. So if your colleagues would like to see this, we'll be able to share that recording with them. Also, we'll be saving a fair amount of time for questions and answers at the end of the presentation. So please get your questions and answers, we'll provide the answers. Get your questions ready. You can use the chat tool, the Q&A tool, or if you have access to a microphone, you can raise your hand and we will call on you and you can ask the panelists directly. Without further ado, I'd just like to share the agenda. It's coming up, promise you. And we're going to give a brief advocacy update after welcoming remarks, and then turn it over to a conversation with the Treasury Department. We're really pleased to have Noel Poyo, Deputy Assistant Secretary for Community Economic Development, and Christopher Weaver, Director of Policy with the Treasury. And of course, we'll close out with questions and audience discussion. Before we get any further, I just want to remind everybody that we have updated resources always available on the Inclusiv website. Please check it out if you haven't already. A lot of great information as well as updates, news, and tools that we share with members and the community there. Also wanted to announce that Inclusiv will be starting a subcommittee on the Paycheck Protection Program with our board. This is open to Inclusiv member credit unions and give you an opportunity to help shape the conversation around the program at the policy level. Please let me know if you're interested in participating. We'd love to hear from all of our members, get them as engaged as possible in this discussion. And without further ado, I'd like to ask our CEO, Kathy Mann, to say some welcoming remarks.
Thank you, Jules, and thank you everybody for joining us this afternoon. I know there's a lot of interest in this topic. I want to especially thank Noel and Chris for joining us and giving us some insights into the upcoming or into the ongoing Emergency Capital Investment Program, or ECIP. We are very excited about this town hall. There's a lot of blood, sweat, and tears went into getting this program together. I know a lot of you who put a lot of effort into working on seeing this policy come forward, and we are really thrilled to now be able to dig in a little bit more. I just want to wanted to quickly sort of make a double pitch on that. That subcommittee of our Government Affairs Committee. As you all know, our policy work is exploding, and there's so many different things and spaces in which we are looking to kind of put that unique community development credit union voice into policy discussions. So the Government Affairs Committee is a place where we come together to kind of organize all the different areas. This is the first time we're creating a subcommittee specific to PPP because there has been so much activity among the credit union sector in that space. There's so many details that we've been sort of managing, and we really want to engage the membership in sort of helping us think about articulating our voice going forward on seeing kind of what comes next with SBA programming. So please consider reaching out to us about that. But also, if there are policy issues that you think are important that you're seeing coming up and you want to put them on our radar, do let us know. We will be working our way through kind of making sure they get down to our radar screen than that of the Government Affairs Committee. So with that, I will turn it over to Pablo to tell a little bit more about some of the other things going on with the advocacy updates.
Thank you, Kathy, and hello, everyone. We're really living these, exciting times. It's been a perfect storm of opportunities. The Rapid Response Program just closed, 2 weeks ago. So I hope that most of you actually submitted your applications. We're hoping that this is going to be a breakthrough in terms of resources coming to CDFI credit unions. We're really pleased with the response and interest that we have seen in the field. So kudos to all of you for doing that heavy lifting. There's another deadline coming up soon, May 3rd. We have the financial and technical assistance application. So I know that many of you are also working hard in that process. So good luck with it, and let's make sure that we are showing to the CDFI fund that there's demand for these amazing grant opportunities that they have provided. We also have, talking about deadlines, we have, of course, the Emergency Capital Initiative program application deadline coming up on May 7th. So this conversation today is really timely. And there's a couple more of updates. You may have seen that there's a CDFI survey circulating. I know that it's hard to make time to respond, but we would really appreciate it if you take that time to respond to it. This is a survey that has been around for a while, but we have been working with the Federal Reserve Bank of Richmond to make sure that this survey really is defined or suitable to the needs of credit unions. By the most part, the survey has been more for loan funds. That has changed. So I'd really invite you to look at our emails and just follow the link and answer that email, that survey. It's important because it gives ammunition, right, about the impact that we collectively as the CDFI industry is making, but also specifically the impact that credit unions are having in their communities. 2 more updates. We have, for those of you that are doing the Paycheck Protection Program, the deadline for borrowers to participate has been extended to May 31st. So something that hopefully will alleviate some of the pressure that many of you are feeling, and hopefully will allow more borrowers, specifically minority borrowers, to take advantage of these resources. And finally, we have been working with our partners in the community development banking side to advocate for an extension of this ECIP deadline. Hopefully, Chris and Noel will talk about it. I know it hasn't been decided, but this is something, again, that we would like to see. We totally recognize the huge challenge that it has been for Treasury to put together this program, especially in the midst of a transition of administrations. We're happy that we're in the hands of these capable leaders, Noel and Chris, but we are also hoping that we're going to see some more time for credit unions to get ready and be able to participate. So with that, I'll quickly introduce our guest speakers today. Noel Poyo, a great friend of CDCU, someone who you have seen before. We have invited Noel to a number of webinars in the past, conversations, when he was the CEO of NALCAP, the National Association of of Community Asset Builders. And now he has a role in the Treasury Department as the Assistant Secretary for Community Economic Development, Office of Domestic Finance. So we're really happy to have Noel be involved in these conversations. And of course, we have Christopher Weber, Director of Policy for the Office of Community Economic Development, as well, a career officer at Treasury Department, someone who's had extensive experience in policy, consumer policy. So we're really happy to have you both in this conversation. And with that, I'll turn it back over to you, Jules.
Sure, absolutely. Well, I was actually going to turn it over to Noel and Chris
Okay.
to
Let's do that
share, then. Yeah, share a little bit. And I'm going to stop sharing my screen so we can focus on the topic at hand. So thank you, gentlemen.
Great. Thank you very much. I really appreciate this invitation, value the opportunity to talk with the membership of Inclusiv. My name is Noel Andres Poyo. I am the Deputy Assistant Secretary for Community Economic Development at Treasury. And within my portfolio, I have oversight of the Emergency Capital Investment Program and the CDFI fund, among other things. And my colleague, Chris Weaver, I think it's important to note that while he has a number of hats that he wears, one of them here is as interim director of the Emergency Capital Investment Program. And so just want to thank him for taking on that more than substantial role. So before we go further, Chris, just any other introductions or points you want to make at the beginning, and then I'll do a little bit of framing.
Sure. So as Noel said, I am the Director of Policy at the Office of Community and Economic Development. I'm serving as the interim director to help stand up the ECIP program. It has been a lot of work that we put in over the last 2 months trying to stand the program up. We still have a ways to go. We appreciate everyone's patience since we are building this car while we're driving it at the same time. So we're trying to make sure that we get out as much clarity as we can around the program as we go along, and that's the purpose of this call today. So hopefully we'll have a good conversation around the program.
Great. So let me just offer a few thoughts up front, and then we can spend most of our time on sort of questions and answers. And so, you know, it's just worth remembering how we received this program. So passed in December, the previous administration spent the following month or so beginning to tee this up. And as was the case with a number of things, you know, maybe it wasn't quite where we would hope it would have been. And so there was, you know, a very serious congressional deadline here, and one that we had a very short time to run at That being said, thankfully, a core team at the Treasury Department, a core team of career staff, really did put us in a position where we could move forward, regardless of wherever the policy decision making was around some of this. And so grateful to that team, and we were able to release this program after a significant engagement with our regulator partners. And we've seen that many of the questions that we've received are questions really frankly as much for regulators as they are for the Treasury Department. And so you'll find that to be a bit of a theme in some of our responses as we talk this through. You know, Congress chose a specific group of institutions here, right? Depository institutions that are CDFIs and MDIs. The idea here was that we already are working with a population of institutions that have proven track records doing the things that the statute set this program up to do, right? To increase capital flow in targeted communities as defined in the statute. And so, you know, it's a really unique policymaking space to be in, because as we wrote the rules here, we're not writing the rules for just sort of any institution out there, right? We're writing a set of rules with a specific targeted institution in mind, one that is already focused on things that CDFIs and MDIs are focused on, and track records that are represented in those class of institutions. And that's a tremendous luxury and a tremendous, and to me, incredibly exciting, right? And so you'll see that in the materials that we've released, soon after the application, we were able to define, particularly in the guidance that provides information about how we calculate the reduction in the rates, a definition of deep impact lending. And we wanted to sort of raise that up to you and say, look, this is an opportunity for us to differentiate between good and great. And like in the banking sector, for example, you've got the Community Reinvestment Act that has a set of requirements, but those are requirements for everybody, right? And so naturally, there's going to be a discussion about sort of how those requirements get absorbed in the field when everybody is in the game. And for us to be able to, in a program which is designed, primarily with carrot and not a whole lot of stick, that is to say, it's already reasonably low cost capital. We've put it out as capital that will be long-term, trying to get the most favorable treatment that we can from regulators. And so we wanted to be able to say, look, this is capital that's designed to let institutions really do what they do best, push the edges, have the deepest impact. And so we want to make sure that we are measuring that, right? So if in the Emergency Capital Investment Program, we had sort of a low bar for just, fill in the blank if you did something that was good, and that's all we were going to collect, I think we would have really missed an opportunity. We really want to be able to tell the story about what community development credit unions do, to really collect that data. And so the idea that we're going to walk out of this program some years down the road with a body of data that really deeply helps us understand the impact that these institutions are having in the marketplace, to me is incredibly exciting, and I think can have a huge impact on the overall market. And so, here I am talking about sort of things down the road, but I know that a lot of the focus here is going to be on the application process in front of us. I will acknowledge up front that that associations representing virtually every eligible institution sent us a letter and said we should extend the deadline. They also went to our partners in the Senate and asked them to send us a letter to the same effect. While I have no news to break today, I'll just say that we really appreciated that unanimity. I think it seems perfectly reasonable, and no news to break today. We're considering that, but just let it be known that we've certainly received that and certainly considering it. And I do want to make sure to just say, sort of a thank you to many of the organizations on this call that have participated so deeply in the PPP. It's extraordinary what CDFIs have accomplished this year, right? Since the Schedule C changes were made, and much of that accomplishment has been through community development credit unions. I want to give credit. I want to say thank you. It's enormously impactful. And I think you are telling a story about what the CDFI industry can do and what community development credit unions can do. And frankly, these were not ideal circumstances. This is a program that I'm well aware, because I was on the other side advocating about this, about just how start and stop and difficult and no transparency and how hard it was to lean into this. And yet here we are. You all have delivered in extraordinary ways. And so let me just say that thank you and appreciation to the field. And let's go to questions. Chris and I will go back and forth in terms of answering, and look forward to hearing what your questions, your concerns, and the opportunities you see.
Excellent. Well, thank you, Noel. Thank you, Chris. I think we do want to give folks an opportunity to ask some questions while you think of your questions and submit them or raise your hands. I think maybe Kathy Kim, our colleague, had some questions that she's been hearing from some of our members to get the conversation started. Kathy?
Great. And Noel and Chris, thank you so much for your time and holding space for our movement today, and for really just understanding, I think, part of the impact and significance of community-led financial institutions like CDCUs. And really, we are so glad and grateful to have this sort of watershed moment to kind of turn these opportunities into further outcomes, especially for our most underinvested communities. And so just to kind of get this part of the conversation started, we've been working with our network on the ECIP program, and we've received several questions, and I'm going to share some of the grouped questions with you today. The first question that we've received a lot of inquiries about is just a high-level overview of what the application review and investment making process is going to be like from Treasury's perspective. Can you walk through the review process and the criteria Treasury will be using to make these investment decisions? And also kind of going back to some of the earlier points that you shared, Noel, has been really about, I think, a diversity of the types of impacts CDCUs have. And so if you can spotlight anything about the specific types of issue areas from lending to LMI communities, rural communities, people of color, if you could expound on any of those details as well, that would be much appreciated.
Yeah, what I want to do is try and sort of wave a flag about a couple of key things, and then maybe turn to Chris to talk through some more of what we've laid out in the Q&As. We think we did address some of this pretty clearly in the Q&As, and we labored over that, so read it closely, right? I want to just sort of highlight that we are going to review the lending plans that are submitted. And that is where we're going to be able to understand what the capacity and what the track record is and the financial strength of the institutions that apply. We will certainly be asking, regulators for their input, but that lending plan matters. Don't assume we know something, right? Because if it's not in there, we don't know it. Don't presume that we have a sense of who your community is or what your tremendous impact on that community has been. Make it explicit. I just want to encourage that sometimes, again, knowing that I've been on the other side of sort of applications like this, it's easy to take for granted all of the extraordinary things that your institution does. Brag, detail it, lay out in as detail as possible with the data that you've got. We understand, for example, one of the big questions was, well, or sets of questions were about like, well, look, what if we don't have exactly that data? Fine. then give us the best data that you've got. Give us the most detail that you can. Tell that story, because it's going to be enormously important and impactful to us as we are doing that review. So with that, sort of waving that flag about how important it is to really don't overlook anything in filling out your plan, Chris, let me toss it over to you and ask you to take it from there.
Sure. So in terms of the review process, just sort of the overview is your applications will be reviewed at 2 levels. So there are individual considerations that we have for every application that comes through the process. And then there are some things that we're going to consider as we look at all of the applications collectively. So at the individual application, there's really 3 components, and we've laid this out in the FAQs that we put out, where it's the condition of the financial institution, their capacity to execute on their lending plan, and their responsiveness to community needs. Am I coming in clear?
Yeah, you are.
Yes, you are.
Okay. So in terms of condition, there's not much that an individual can do in their application to respond to that. This is largely a conversation between Treasury and the regulators looking at the financial condition of the institution. Our analysis really boils down to trying to assess the ability to make the dividend payments that are required, or the interest payments in terms of sub-debt from the financial institution. So we have a series of asset managers that are working with us. We're having a conversation with the regulators around that, but that's number 1 in terms of the review of the application. In terms of actual capacity, this is the area in the lending plan that Noel has mentioned that you should give us as much data as humanly possible. Don't assume that we know anything. We will look at your track record. There are some questions that are in the application that have you detail some of the things you've done over the last couple of years. And we really want you to put as much effort as possible into thinking about how you've impacted particular communities in terms of your track record. That section should also have things about your skills and experience and the personnel that will be executing on that lending plan. And then in terms of responsiveness, this is how well do you know your community? We're going to get hundreds of applications. We won't have time to research all of the data on every single community. So you should tell a story in that section about how COVID has impacted your particular community and how your lending plan is responsive to those needs. And so it's condition, capacity, responsiveness. Those are the 3 things that we'll look at in active. Now, once we've seen all of the applications, everything has come in, we also will go through all the applications to try to make sure that we're getting demographic and geographic coverage for the country. So there may be some adjustments to allocation once we've seen the entire picture to make sure we're not missing any pockets throughout the country. And as well, we have to consider that there is a set aside for institutions based on asset size. So that's sort of an overview of the process. We can get into more detail at a later date, but that's what we put out now in terms of FAQs.
Great. Thanks so much, Chris. And with folks on the line today, we'll make sure to share copies of the updated FAQs, which can also be found on Treasury's ECIP website. So another question that we received, well, we'll just follow up on that note regarding the lending table. Jules, do you want to share the question we just got from Allison?
Absolutely. Thanks, Kathy. The question is, what do you expect from that first bullet of the application before Q1? That the applicant must provide documentation that supports its responses to Q1 through 4. In supporting the chart in Q1, what documentation are you asking for with this note? What are you looking for there?
We're looking for what you've got. And so I want to make sure to underline that for as much as, there is a specific, sort of group of institutions here, there is significant diversity, right? And significant diversity of regulation. And so I really want to make sure to encourage you to provide the most detailed information that you are able that supports the lending plan that you're laying out. And so, we are not going to say, well, only this kind of data or only that kind of data. obviously we want data that supports the projections and the numbers that are put in there. But I want to be careful about sort of saying only this or only that, right? We know different institutions are going to be able to, whether it's because of regulatory questions or whether it's because of, systems and capacity questions, what have you. And so data, quantitative and qualitative, we are open to you telling your story. Chris, I jumped on that one. Sorry about that.
No problem. I just wanted to clarify that in question 1, that's backwards looking. It's looking at your track record over the last 2 years. Question 3 is prospective. It's asking you what are your projections on what you're going to do in terms of lending throughout the 10-year life of the investment. And so 3 is much broader than 1 because 1 primarily focuses on individuals. It's LMI borrowers, other targeted population. So that's focusing on individual borrowers. Question 3 is much broader than that because in terms of qualified lending, it can be both people and place. And so if you look very carefully at the application, you'll see that there is a distinction between the two. 3 should be a much bigger number than what we're seeing in 1.
Great. And on that note, because we've received several questions regarding the full application, but really around 1 and 3. And so just to kind of clarify and confirm, because I saw that in the FAQs, Treasury did provide a bit more guidance on what is called definitive evidence and the sort of request for, I think what Allison's referring to is that sort of what looks like a footnote, but is actually a note to include more information on the methodology that's being used to do that backwards looking like impact segmentation and analysis that's being referenced here. And what I'm hearing is that from Noel and Chris is that you just want us to tell our story, use the best efforts based on the data that you have. One question that we've gotten from folks is there's going to be a preference? I think there was some ambiguity regarding the FAQs. And if this is something that needs to be tabled, that's fine. But it seemed like there was being additional weight placed on definitive evidence. But Noel, like you acknowledged that really it's going to depend on the institutions. Different regulatory agencies have different requirements. And so does Treasury know yet whether all like methodologies, as long as it's reasonable and it's justifiable, will be equally weighted, or is there going to be some additional weighting to those that use quote unquote definitive evidence?
I'll jump in there, Noel. So in the FAQs, we lay out sort of 3 separate approaches. So 1 is the one you described, the definitive evidence. 2 is the proxy, and 3 is essentially just reliance on your CDFI or MDI certification. And so option 1 with definitive evidence, we fully recognize that there are some reasons, regulatory or otherwise, why some of that data may not be available. So someone to provide 100% definitive evidence, that's probably highly unlikely, and we are aware of that. Now, the statute does require us to use our best efforts to try to collect this information. So it's possible that in the mortgage space, for example, some folks may have a lot more information around rates than they do on other categories of lending, and they could lay out in their application definitive evidence that they have available in terms of mortgages, and on their consumer loans, they may use proxies. In terms of us talking about the weighting, Congress did go out of their way to try to make us consider people's ability to reach individual LMI borrowers and minority borrowers. And that's what that section is all about. So it's not a place-based consideration. So that minimum threshold is around people and not places. And so if a particular institution has historically gone out of their way to collect that sort of data, that is an A application, and we recognize that those will be very few. But what we're asking is for people to really use their best efforts to try to come up with some reasonable probabilities around that type of data that we're trying to collect. And so it's not a question of where it's us looking to critique one methodology versus another. Where if people are using their best effort, they will fall in that second bucket. But I think we will recognize those applications that haven't put in any effort at all, and they just say, I'm a CDFI, there's a 60% threshold, that's people in place, and that's all I'm relying on. That's the C category, and I think we recognize the overwhelming majority of people will probably fall in the B. Is there anything you'd like to add to that, Noel?
I think you're muted, Noel. And I know it's a really good
always
point.
always helpful. So I want to make sure that I underline that neither the FAQs nor what I said just a moment ago suggests that we will not differentiate between types of data, right? I didn't say anything about weighting, right? So what I want to make sure is that institutions don't feel like they can't bring the data they've got to the table, right? So they should bring anything they've got to the table that tells that story. Now, we all know that an institution that can bring more definitive data, as Chris said, about their ability to have impact in the targeted communities, well, then that's probably better, right? And so I just want to underline that I was not suggesting, nor does the FAQ say, that we don't recognize the difference between different kinds of data. I just want to absolutely make sure that institutions don't decide, well, we don't think that data is good enough, so we're just not going to put it in there. If there's something that the institution feels like tells their story, then they should use it.
Great. Thanks so much for those clarifications. I think going on to, go ahead, Jules.
I just wanted to run through a few more questions, if possible. First of all, just wanted to highlight that in the chat, Kathy provided an answer to a question around deep impact lending. There are some key definitions, and there's a link to that in the chat. This is from Megan, who says, we are new to the CDFI process and the ECIP grants. If we're currently, ECIP technically is not a grant program. I just want to point that out. If we are currently going through the CDFI certification process awaiting approval, are we still eligible to apply and be considered for the upcoming ECIP process in May?
So if you began the CDFI certification process before December 27th, 2020, the date the statute was passed, and you are approved before you submit your application, yes.
Thank you. Kathy, anything you want to add?
Not to that specific question.
But I do have a question. Chris, that statement that you just made, would that be true if there's an extension on the deadline?
Yes, that will still remain true. It would be submitted the application before December 27th and certified before submitting your application. Even if there's an extended date, it would still be certified by that date.
Okay, thanks.
Thank you. So Kenyatta asks, from a condition of the financial institution standpoint, will the ECIP application take into consideration the COVID-19 affecting the financials for smaller credit unions? We are hit hard in generating income. Will you be looking at data prior to 2020 as well?
So we've had that conversation with the regulators. We've had that conversation internally at Treasury, and we recognize the impact that COVID has had on the institutions. So we will be looking back over a 3 to 5 years at all institutions to try to make sure that what happened in 2020, that whether or not that's representative of the way the institution typically performs. We're looking at over the long term, over the 10 years, the ability to make the interest payments on the sub debt. And so we recognize that this 2020 may not be representative of that.
Right, and I just add a couple of points that were included in the legislation. Adding to what Chris said, if your institution will not be eligible if you're currently categorized as troubled, according to the NCA regulations, which means you have a CAMEL rating of 4 or 5, or if you're currently receiving Section 208 assistance, or if you have a current finding that says you currently have unsafe or unresolved findings regarding unsafe lending practices. And again, happy to share the language around that. But I think exactly what Chris said, it's that plus I think some of the language I just mentioned that's codified in the act that you want to be mindful of. Great. Jules, did you have other questions you wanted to spotlight, or should I continue with the questions we received from folks before the webinar?
Just had two more that I was hoping to get through. First of all, from Robbie, can you walk through the expected timeline for investment decisions and funding awarded investments?
Yeah, so Treasury has not publicly laid out a timeline for when investment decisions will be made, in part because we can't reasonably do that until we understand the demand that we receive at the end of the application period. This gives me the opportunity to sort of underline, because it's been a confusion for some, that this is not a sort of first come, first serve or get reviewed as you get it in. There is no incentive here for you to rush. There is an open application period. At the end of that application period, make sure you've submitted your application, and that will put Treasury in the position of reviewing rather a large number of applications, we hope. And as such, we will likely then start to make some representations about timeline once we understand what that application demand is. But at this time, look, you should expect something to happen this year, but I'm not going to get any more specific than that because it all really relies on application demand.
Thanks. Another question before I turn it back over to you, Kathy. Allison asks for that question 3, it refers to a 10-year term, and the term sheet for subordinated debt says 15. Should we assume the term sheet is the correct term and answer Q3 accordingly?
So you should assume the term sheet is correct. The secretary had some discretion around the terms of the term sheet, and since it's not perpetual the way the preferred stock is, we decided to give the sub debt a little bit more time in terms of the maturity, and so the 15 years in the term sheet is the accurate number.
Thanks, Chris. And for folks on the line who are not familiar with secondary capital, and thanks so much. We've received a lot of questions around that, Chris. I think I would imagine it's also related to the amortization schedule that's required for secondary capital investments. So the way Treasury's kind of structured this, while it says 15 years, what that means in terms of like, as you kind of work on your financial projections, that full capital amount would count towards your net worth for the first 10 years. And so that would be one sort of like practical takeaway from what Chris just clarified.
And I'm sorry I said that was the last question, but I got another one that snuck in, and I think it's a relatively quick one for clarification purposes. If a financial institution is not yet a CDFI, they must have applied for certification by December 27th, 2020, and they must have received their certification before they can submit an application for ECIP. Is that correct?
That is 100% correct.
Thank you.
Great.
Back to you, Kathy.
Yeah, and kind of going back to the sort of like baseline questions regarding rates and terms, Chris and Noel, can you also clarify what the rate on the sub-debt for credit unions would be? It says 2% across the act and the term sheet, but there was language, one reference within the rate reduction guideline that said sub-debt would be a max of 2.5%. Can you add any clarifying comments for folks on the line with us today regarding what rate they should be accounting for? And again, we're aware of the sort of like rate reductions that are available, but where does the 2.5% come in, and should they take that into account when kind of modeling out their financial projections?
So no announcements on that yet. I will say that I'm not a tax lawyer or a CPA, but there are some tax reasons why we wound up with the 2.5% on some of the sub debt. But we're in conversations now on whether or not that may change. So nothing to announce on that yet. But for now, I think you should assume that it's the 2.5%, and it's there for some tax reasons.
Okay, thank you for that. So we know we've been working with quite a few credit unions and they're working on their application and they want to make sure that they get it right. So 2.5% is what should be included in the models. So we had a few additional clarifying questions regarding the application. One goes back to, we had a couple of questions regarding question 3, which Chris, you did a brief overview of, a few moments ago. One question we had was with regards to question 3A, which asks for credit for applicants to provide the additional aggregate dollar amount of loans, grants, and forbearances that the credit union, in our case, projects that they'll be providing over the 10-year term of the investment. There are a few different, methodologies and approaches that one could take. Do you have any guidance that you could share with folks on the line today, whether Treasury had a set sort of methodology in mind and or key considerations you think folks should account for when responding to question 3A?
I think that we have to be careful here about going beyond an application format that's been laid out, FAQs that have been put out. We're not going to signal sort of preferences beyond what is sort of clearly in the material that we put out. So I do want to be a little careful about doing that because I don't think that would be helpful to folks. Chris?
No, the only thing I'll say is just to reiterate what I said earlier, that question 3 is forward-looking. So that is all of your qualified lending over the 10 years. It's not just the borrower focus that's in the question 1.
Great, and then also just for 3B, a point of clarification, the language under 3B asks for an explanation on how the applicant plans to expand or maintain significant lending or investment activity in LMI minority communities. Several credit unions asked whether this is LMI and minority communities or it's and or. Can you provide additional clarification regarding question 3B?
So yeah, it's and or. So again, 3B is forward looking. That's all qualified lending, which would include both LMI and minority communities.
Okay, so it's not specifically low and moderate income communities of color. It's low and moderate income and or communities of color, all the sort of key targeted sort of communities that are really at the center of ECIP.
That is correct. And I think that if you, the language that's in there, it goes through the categories. You match that up against what's rate reduction guidelines. You'll get a pretty clear picture of what qualifies as qualified lending, and that's what it's asking for in that section.
Okay, thank you so much for that. I think some folks that have been sharing their questions with us were trying to match the two, and they didn't know if the first one had to be like the sort of like LMI, the borrowers that are both LMI and people of color. So that was really helpful. Thank you, Chris. To that end, sorry to go back to table 1, but our hearts are stuck on it and just really wanting to be as accurate as possible. So in the table on the top line, folks are supposed to, credit unions are supposed to report the past 2 years of loan originations, and then some forward-looking, right, estimations just based on past performance and their growth strategies and business plans, et cetera, et cetera. With that having been said, row 2 then kind of has the LMI lending to individuals. And then under that, there's OTP, individual borrowers of color. Many of the credit unions that we've been working with and are interested in this program, we're kind of scratching their heads because for some, a significant percentage of their borrowers of members of color actually are counted under LMI. Can they, demonstrate that sort of like, impact or key sort of data elsewhere, or how should they address that part of the lending table that is being required? So
the instructions that they should not repeat or duplicate double count those loans in any of those boxes. And so if they're trying to show their ability to reach minority borrowers and those borrowers are also LMI, it probably would be wise for them to include them in the minority category and not in the LMI category. because they're demonstrating their track record of reaching minority borrowers. But they can do it the other way around. If those are all of my borrowers in the minorities, they can put them all down on LMI borrowers and don't include them in the minority categories. But as long as they're not duplicating, it's fine.
Okay, and then perhaps could folks just add the additional sort of, deep impact lending or expand upon that, those, data points elsewhere in the application, like in the narrative?
So in the narrative, they can, again, as Noel said at the beginning, don't assume we know. And so if they include them all on the slide, but they want to make a point about their ability to reach minority borrowers, I think in the narrative section, then it would be wise for them to put that detail there.
Terrific. Thanks so much for that. Okay, had a couple of additional questions regarding the rate reduction guidelines, and then also any insights you could share to the extent that it's available regarding future reporting and compliance requirements.
So on future reporting, we will release more on it, and we haven't yet. And so I don't have a whole lot more to say than what you see already, right? The statute has some clarity. Treasury is not going to make huge news by inventing all kinds of things, crazy things beyond what we've already put out. But additional guidance on reporting will come.
Great. Chris, do you have anything to add to that before we turn over to the questions and clarification requests regarding the rate reduction calculations?
I don't think I understood what the question was around the rate reduction, what the question was.
Oh, sure. So I just said that the topic. We received a few questions. Oh.
Sorry, we also had 2 open questions that came in. Every answer sparks a new question. So Kathy, I don't know whether we want to talk about the rates or get into that.
Sure. Well, let's let Chris choose, because we did receive, I think, at least like 7 different inquiries regarding the rate reductions.
Okay, so let's go into that, please.
Sure. So there's guidelines, that Treasury has published on the ECIP website. We received several questions regarding, what the timeline for qualifying for the rate reductions might be. We know that for the first 2 years, it is interest-free, non-accrual. But do ECIP borrowers have a certain timeline by which they must achieve or, leverage the capital investment by, whether it's, 2x or 4x in order to receive the rate reductions? Will the qualifications for or eligibility for rate reductions be reviewed on an annual basis? Is there any additional information you could provide to folks on the line with us today about what that process might be?
So according to the statute, we have to establish a baseline for all the participants. And that baseline is the 4 quarters leading up to September 30th, 2020. And so we will have that data from the application in order to establish the baseline. And then it is an annual review that we're required to do beginning in year 3. So again, first 2 years, there are no payments that are due at all. It's non-accrual. And then in year 3, we will review your increase in loan originations in year 3 and compare that to the baseline. And we will do that on an annual basis all the way through years 2 through 10.
And Chris, just to follow up on that, it's not something that borrowers would have to requalify for. Once the rate, you've leveraged the capital by, that X factor, then that rate would be set, or is this something they'd have to requalify for based on the annual review?
So because the statute requires an increase in originations, theoretically, I'm not sure if it's a really realistic scenario, but theoretically a person could decrease their lending and their rate could go back, because every year they're reviewing to see whether or not it's 200 to 400% higher than what it was in that baseline year. And so if they pulled back on the amount of loans that originated in years, in theory, they could go back to 2%.
Got it. Thanks for the clarification, Chris. Jules, I saw that we had several questions kind of come in. Turning the mic back over to you.
Thanks. Quick follow-up, what happens in years 11 through 15?
more guidance to come out to Treasury on that. I will say that it is right now, it is a 15-year instrument. The terms don't change in years 11 through 15. Year 16 is another story. And so there's still guidance to come out on that.
Great. Should we expect any additional information on what will count as qualified lending in targeted communities before applications are due? Appreciations for any additional clarity in the FAQs.
I don't believe you should expect more on qualified lending. One, it's clearly defined in the statute, and then we have defined deep impact metrics. We welcome input or thoughts about that, and so perhaps you can influence us, but I would not at this time expect us to be sort of moving things around like that during the application period. We want folks to be able to run this application with relative clarity, and we think that we've put that out there. We're getting sort of towards the end of our time, and I want to just make sure to take the opportunity to sort of acknowledge here that this is a program that on its face gives access to really good capital, right? But we also acknowledge there's risk here. Going in and taking a significant amount of capital from the federal government makes some people nervous, right? There were folks in different institutions that were back and took TARP money and didn't like the way that turned out. We know that there is this balance, right? This tension that institutions will have to resolve when they decide whether to apply and how much to apply for. Let me say this, that Congress wanted this money to get to your institutions. This administration wants this to be a transformational program. I know that this administration is like any administration, has a certain amount of time. But I'll say that I want to strongly encourage institutions to come out, apply for this money. If you feel like there is a lack of clarity that you really need an answer to, that might get answered between an application and when final investment documents get signed, which will take a little while. We've got to underwrite quite a few of these things, is my guess. Don't screen yourself out, right? No one has signed a document. When you submit an application, all you're saying is that this is truthful. You haven't signed your lives away or mortgaged your house or anything like that. And so I just strongly encourage institutions to demonstrate what your appetite for this is. Because if we have institutions that decide to screen themselves out and say, well, I don't know, it just seems risky and maybe we would, but it's just not 100% clear to me right now. And we end up with lower application demand, which actually doesn't reflect the capacity of the field, I think we will have missed an opportunity. This can be a transformational moment for community development credit unions and the rest of the CDFI and MDI community. And we need your partnership to make that happen. Partnership sometimes means that you need to beat us up a little bit and yell at us and lean in on us and tell us we got it wrong or we need to get it more right in some places. We don't bruise easily. We don't, our egos aren't going to get hurt. We're not scared of that engagement, right? But don't screen yourselves out. Lean into this opportunity, show Congress that their faith in this field was merited and that there is a real demand for capital that can transform how dollars flow into these targeted communities that we are all so concerned with. So I'm making my pitch to you. I'm asking you to lean in with us, and we're willing to lean in with you.
Yeah, and Noel, I think that we are all convinced of the impact that this program can have on the industry. I think that the hesitation is not that people are trying to screen themselves out or that there's a prevalent feeling that this is, government money that invites, a level of scrutiny. It's more an issue of the complexity of the program, specifically when we're talking about smaller institutions. And I think that that's really the balance that you guys are going to have to kind of walk around, right? You're talking about deep, and you're talking about capacity. And we have amazing MDIs, CDFI creators that are lending really deep, but they're not lending at the scale that you may be expecting. So I think that that's going to be one of the challenges for participation of especially smaller CDFIs.
I do want to, Paulo, take a moment to push back a little bit. The question of complexity is one question. And to the extent that there are aspects of this that are overly complex, I really want to hear about them. I really want to get challenged quite specifically on them. Because we tried to hew closely to a statute, right? Now, there is some level of complexity in the statute, but I think small institutions can take advantage of this just as larger ones do. I do, however, appreciate the challenge, right, of managing investments from Treasury and what's implicit in that. But we are very clear that smaller institutions have a value in this space and larger institutions have a value in this space. And I hope there won't be any assumption, because I don't believe there's anything we've written that suggests that one is more important than the other.
Yep, we got it. And we really thank your commitment and your leadership here. Both of you have a monumental task managing this. It's like flying and fixing a plane, as you fly it. So we appreciate that, and we trust your judgment and the way that you guys are approaching this. And yes, we have been promoting and actively supporting Kathy and Kim, and her team have been working and providing technical assistance to as many members as we can. So yes, we totally understand and see the transformational opportunity this program provides. So thank you.
Now, and yes, thank you for that point, Noel, or those very important points. We're a few minutes over time, but we had 2 additional questions I was hoping we could get to. Is that all right with our panelists?
Yeah, I myself have a couple of minutes, and happy to be quick.
Thank you. Yes, we'll try to keep it quick as well. There was a reference to transferability to an affiliate. Does that affiliate have to be listed in the application, or can the affiliate be proposed at a later date if that transferability does indeed move forward?
This is pointing to an extraordinary element of the statute that gives a very interesting flexibility to the secretary. There is nothing that we are saying here or that we have published that should be taken that should be understood as limiting in any way, shape, or form that flexibility given to the secretary. So I am most intentionally not answering that question because we have not spoken to it. We did not mean to speak to it, and it is a flexibility that is in the hands of the secretary that the secretary may choose to publish something about later, but at this time has not.
Well, thank you for that non-answer. Chris, it sounded like you were about to answer that as well. Is there anything you wanted to add?
No, I don't have anything to add to that. I just think that people applying for the program should assume that they can abide by the terms that are in the term sheet.
Wonderful.
Sorry, Jules, I had one additional clarification. I know the question, what happens in years 11 through 15? Again, not to speak for Treasury, but I'll speak on behalf of what is already codified in the NCUA regulations regarding secondary capital. Federal government funded secondary capital loans can be repaid at any time. And so that's different from, I think, what we see with standard secondary capital, where you have to wait to amortize. So that's something else, like as Chris and Noel mentioned, Treasury will be providing additional, we might see additional information come from that end, but I did want to clarify from what's currently in the NCUA regulations that credit unions would be able to repay the loan even if it's not amortized by the end of year 10. So I'll just put that out there for folks to keep in mind.
Thank you, Kathy. Final question. This may be in the FAQs, but what is the deployment period for using the funds?
I'm not sure I fully understand the question. It's not a grant, and there isn't a deployment period in that sense. This is an investment. Obviously, the institution is going to define its own projections in the lending plan, but I think that question might reflect sort of a little shift in sort of thinking about what kind of money this is. This is an investment in the institution that the institution can use to pursue an investment plan or a lending plan that it gets approved by Treasury. So I'll leave it at that. Chris, would you say anything else to?
No, I wouldn't say. I think Noel said at the outset that this is a program that's largely has carrots and very little sticks. And so the limitations on what you can do with the money and when you can do with the money, there's not much there. It just incentivizes you to do the things in order to earn the rate reduction.
Excellent. Yeah, I think that was the answer we expected. Thank you. Okay. I think that's all the questions that we had. So thank you to our panelists. Thank you, of course, to Chris Weaver and Noel Poyo from the Department of Treasury for taking the time, being so generous with your time, and also so helpful in answering these questions. I just wanted to, if I can, just remind, I'm a little herky-jerky with the PowerPoint today. But if we can get it up, there we go. Excuse me, next month's town hall call will be May 11th on Tuesday. I hope to see all of you there. Treasury is invited as well if you want to join us again. Just wanted to remind you, here's my contact information, Pablo's contact information. If you didn't know already, Kathy Kim is a tremendous resource at Inclusiv. So we don't have her contact information up here, but it's in the chat. And actually, I think, Kathy, you sent it just to the panelists, but we can connect you with Kathy Kim and make sure that you get all your questions around secondary capital, subordinated debt, and of course, ECIP answered. Once again, thank you all for joining us. It's been a pleasure. Thank you again to Noel and Chris for your time today.
Thank you so much.
Thank you.